Okay, let's get right into it. Something really unusual is happening in the global silver market right now. We're seeing a massive disconnect where the price on a screen in New York is telling one story, but the price for actual physical silver on the other side of the planet is telling a completely different one. And that gap is getting wider by the day.
So here is the heart of the mystery. In China, if you want to buy a real, physical silver bar, it's going to cost you around $90 an ounce. But at the exact same time, the COMEX price back in the US, which is the main market for paper contracts that promised you silver, is trading near $77. This isn't just a small difference, it's a huge chasm between the price of a financial promise and the price of the actual metal.
That's a $13 gap per ounce. And let's be clear, this isn't just everyday market noise. The source material we're looking at suggests that a gap this wide is a major red flag. It's a signal that something fundamental could be breaking down between the world's paper and physical markets.
So, that brings us to the big question for this entire explainer. What is going on here? And why does this $13 gap even exist? We're going to break down exactly where this price difference is coming from, why China is at the very center of this story, and what it could mean for the whole global market.
So, where does this $13 difference actually come from? Well, to understand that, we need to dissect the price itself. The source material makes it clear that this gap is not just some arbitrary number. It's built on real, verifiable costs, the cost of turning a number on a screen into a physical bar you can hold in your hand.
That extra cost has a name. It's called a premium. It is the amount you pay on top of the base screen price, and it covers all the real-world stuff, finding and securing the raw silver, refining it, making it into bars, and getting it to a dealer. It is, quite simply, the price of reality.
Right now in China, that premium is running about 1.5 yuan per gram. And the source breaks it down pretty clearly. First, about 1 yuan of that is just the cost to get the raw silver material. Then, you add another 0.4 yuan for all the industrial work, the refining and fabrication. And finally, a tiny 0.1 yuan is the dealer's margin. These are all real costs in the physical supply chain.
And get this, that tiny 0.1 yuan that goes to the dealer, that works out to a profit margin of about half of 1%. This is a huge clue. It tells us the premium isn't being driven by dealers getting greedy. The market is too competitive for that. It is overwhelmingly driven by the actual hard costs of producing and delivering the metal.
Okay, so we have established that the premium is real, and it is based on costs in China. But you might be wondering, why does a local premium in China matter to the rest of us? Well, the answer is all about China's absolutely dominant position in the global supply chain.
Just look at this number. China is responsible for roughly 70% of the entire world's silver refining capacity. 70%! That means the vast majority of silver that gets used around the world, whether for your solar panels or for investment, has passed through a Chinese refinery. This gives them an incredible amount of influence over the physical market.
And let's be very clear about what we are talking about. This is not just about coins and jewelry. Silver is a critical strategic metal. It is essential for solar panels, for electric cars, for 5G networks, AI data centers, advanced defense systems, medical equipment, you name it. All of these vital, high-growth industries need a steady supply of silver.
Now, let's introduce a ticking clock into the equation. There is a specific date coming up that is poised to make this whole situation even more intense. And it's a big part of why the market seems to be bracing for future scarcity right now. That catalyst is a new rule that takes effect on January 1st, 2026. It is called Special State Licensing. In simple terms, it means that any and all silver exports from China will require direct approval from the government. This effectively gives the state a switch to control, slow down, or even completely stop the flow of silver leaving the country.
And you do not have to guess if the market is paying attention. You can see it right here. The premium over the COMEX price used to be just a couple of dollars. It has now exploded to $13. That kind of exponential growth tells you the market is already pricing in the massive potential impact of these upcoming restrictions.
So, the logical question is, why don't traders just buy the cheap $77 silver in New York and sell it for $90 in China to make an easy profit? That process is called arbitrage, and normally it would close this gap. But the source explains it is not that simple. It is being blocked by long shipping times, logistical nightmares, and the huge regulatory risk of being able to get the silver back out of China. On top of that, getting physical delivery from COMEX can be a real challenge in itself. So all of this is setting the stage for a major showdown, a conflict between the price in the financial paper market and the price in the real-world physical market. And the source lays out a pretty compelling thesis for how this conflict is likely to resolve.
Let's just be crystal clear on what these two diverging markets are. You have the paper market, the COMEX, which is trading in contracts. It is basically a promise of silver, priced at $77. Then you have the physical market in China, which is dealing in actual silver bars, driven by real supply and demand, pricing them at $90. One is an idea, the other is a physical object.
So, how does this resolve? The source predicts a potential chain reaction. First, industrial users who desperately need silver will get worried about the China situation and rush to the COMEX to try and secure any physical metal they can find. This sudden flood of buying forces anyone who bet against the price, the short sellers, to buy back their positions, which pushes the price up even more. As the price rises, arbitrage finally becomes profitable, adding even more buying pressure. And the end result could be the paper price being violently dragged, kicking and screaming up to meet the undeniable reality of the physical price.
And this brings us to the final and most provocative thought from the source material. It says that when a major disconnect like this opens up between a paper promise and a physical reality, history shows us that the resolution is always the same. Physical wins, paper adjusts. The paper price must eventually surrender to the price of the real thing. The only question is not if, but when and how fast that adjustment will be.